The Dow just surged more than 300 points in a single session, and the reason might not be what you think. Most headlines are pointing to a temporary calm in the Middle East as the spark for this rally. Tensions between Israel and Iran have eased, and Iran has reportedly signaled openness to renewed talks. As a result, crude oil prices pulled back, with WTI crude trading near $71.77 a barrel. Wall Street interpreted the de-escalation as a green light. Risk was back on. But beneath that surface narrative lies something deeper and potentially more dangerous. Because what just happened wasn't a calm return to normal. It was a pressure release, a collective exhale from a market that's been holding its breath for weeks. And that kind of relief can vanish overnight. The Dow Jones Industrial Average jumped 317 points, or roughly 0.8%, closing at 42,515.09. The S&P 500 gained 0.9% to finish above 6,033, and the Nasdaq ripped higher by 1.5%, closing near 19,701. Tech names led the charge, with semiconductors and AI-linked stocks rebounding sharply. Financials and consumer discretionary followed closely. Meanwhile, energy stocks cooled. The risk-on trade returned almost instantly. Here's the catch. None of the underlying problems that triggered last week's volatility have been resolved. Bond yields remain elevated. The 10-year Treasury yield is currently hovering between 4.41 and 4.46%. That's well above neutral, and it continues to apply pressure to both equities and credit markets. Inflation hasn't disappeared. Core inflation remains stubborn, and the Fed's preferred measure, core PCE, continues to run above its 2% target. So why the rally? Part of it comes down to positioning. Heading into this week, hedge funds and institutional traders were net short. Sentiment was defensive. Volatility premiums were rising. When oil prices dropped and geopolitical tensions eased, it sparked a wave of short covering. Algos triggered momentum buying, and retail traders jumped in after the move had already begun. This is the danger of headline-driven markets. One moment of calm and the narrative flips, but calm doesn't mean safe. It means quiet, and quiet can be deceptive, because while equities rallied, the fundamentals didn't change. Inflation expectations remain elevated. Consumer credit is tightening, and corporate earnings guidance for the second half of the year remains cautious. That's why veteran traders aren't celebrating this bounce. They're bracing for the next move, and it could come quickly. In just a few days, the Federal Reserve will issue its next policy statement. While the Fed is widely expected to hold rates steady, all eyes will be on Jerome Powell's tone, because if he hints at rate cuts, markets could overheat. But if he leans too hawkish, the rally could reverse sharply. It's a no-win situation, and Powell knows it. Layer in the broader macro environment. The U.S. national debt just crossed $36.2 trillion, and interest payments are approaching $1 trillion annually. The fiscal path is unsustainable, yet largely ignored during bullish trading days. But the debt doesn't go away when stocks go up. It keeps growing, silently and relentlessly. And while inflation has moderated from its peak, it hasn't normalized. Food prices remain sticky. Rent inflation continues to lag official indexes. And wage growth, while cooling slightly, still feeds service sector price pressure. Meanwhile, global liquidity conditions remain tight. Central banks in Europe and Japan are walking a fine line. Rate differentials continue to drive capital flows, and the dollar's strength is becoming a headwind for multinational earnings. So what does today's rally actually mean? It means relief, not resolution. Because while the index is printed green, internals told a more cautious story. Market breadth was limited. Most of the gains came from a narrow set of mega-cap tech names. Volume was light. An options market showed an uptick in put buying, even as stocks surged. In other words, this wasn't a confident move. It was a reaction, a reflex, a temporary exhale from a market that's still waiting for real clarity. Here's a critical stat. More than 60% of all one-day rallies over 2% in the Dow since 1980 occurred during bear markets or periods of economic stress. That's not a coincidence. It's a symptom. Fast rallies in fragile markets are not signals of strength. They're signals of uncertainty. And if you zoom out, the chart shows exactly that. The Dow remains below its recent highs. The S&P is testing resistance. The Nasdaq is overextended. And earnings season is just around the corner. That's when the next reality check will arrive. Because rallies born from relief require confirmation from earnings, from credit markets, from economic data. And right now, that confirmation is missing. Meanwhile, consumer behavior is shifting. Credit card delinquencies are rising, savings rates have dropped to multi-year lows, and demand for subprime auto loans is beginning to decline. These are not signals of a healthy consumer. They're signals of exhaustion. Institutional desks are watching closely. Many have already begun rotating out of cyclical sectors and into more defensive names. Staples, healthcare, and utilities have seen a quiet bid over the past 2 weeks, a classic sign that big money is preparing for turbulence. It's a reminder that the market isn't always what it seems. Price moves can mislead, headlines can distract, and short-term rallies can mask long-term fragilities. So what should you do? Stay alert, don't chase price. Watch yields, not headlines. The bond market is still the truest signal in this environment. And right now it's flashing caution. The Fed hasn't declared victory. Inflation hasn't surrendered. And the fiscal trajectory of the U.S. remains deeply concerning, no matter how good a green screen looks on your trading app. This rally might hold, but it also might fade just as quickly. And if you're not careful, you could be left holding risk while the narrative flips again. So stay sharp. Monitor the flows, focus on fundamentals, and never confuse calm with safety. And if you want daily breakdowns like this, built for speed, precision, and clarity, subscribe to Wealth Signal. We decode the market so you can move smarter. Another key signal that's often overlooked during rallies like this is liquidity. While equity indices may be surging, underlying liquidity conditions have not materially improved. The Federal Reserve is still operating under a regime of balance sheet reduction. Quantitative tightening continues to drain reserves from the banking system, and that liquidity vacuum has downstream effects, especially on smaller financial institutions, corporate credit spreads, and high-yield borrowers. In fact, the high-yield bond market is flashing caution. Spreads between high-yield bonds and treasury securities have quietly widened in recent weeks, even as the major indices rally. That's not confirmation of economic health. That's a warning signal from credit markets. And we're seeing stress in corporate balance sheets as well. More companies are issuing profit warnings ahead of earnings season. Margins are compressing. Input costs, while off their highs, remain elevated for industries like manufacturing, logistics, and construction. Companies that thrived under zero interest rates are now navigating a world where capital is expensive and mistakes are punished. This is especially true for growth-oriented tech firms. Despite today's bounce, many remain far below their all-time highs. Investors are increasingly selective. Only firms with strong cash flows and durable moats are being rewarded. The era of free money speculation is over, and the new regime rewards prudence, not hype. Meanwhile, labor market data has been mixed. While unemployment remains historically low, job growth is beginning to decelerate. Small business hiring has slowed. Job openings are trending downward. And several major retailers have announced layoffs in anticipation of slower consumer spending in the second half of the year. None of these data points scream collapse, but they do suggest fragility. That's the paradox of today's rally. It happened in the face of mounting evidence that the recovery is not as solid as it appears. That does make the bounce invalid. And if you want daily breakdowns like this, built for speed, precision, and clarity, subscribe to Wealth Signal. We decode the market so you can move smarter.